Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Investment Strategist Ryan Grabinski. Ryan, how are you doing today?
I'm doing well. It's always good to be here. How's everything going on your end?
Yeah, all good over here. Appreciate you checking in. A lot to get to here, and we'll start with the big thing for next week, which is the Federal Reserve meets. They're widely expected to begin their interest rate cut cycle after a long pause from their last hike. Inflation has obviously come down meaningfully, and we're starting to get some cracks in the labor market. So widely expected to see that first cut. What are you expecting from the Fed maybe this year and potentially next year? And also for the market implications, how does the stock market usually react to the first Fed cut in a cycle?
Yeah, that's a good. I think that's a good place to start. Obviously, we are expecting the Fed to cut rates. The market expectations are kind of bouncing between a 25 basis point cut and a 50 basis point cut. It seems like today it's moving more towards that 25 basis point cut. But at the end of the day, what really matters is that the Fed is going to start its rate cutting cycle. So what does that historically mean? Historically, when you have begun the rate cutting cycle, it's actually a time to position more defensively within the equity market. So we've looked at sector performance following first rate cuts, and historically the consumer staple sector, the healthcare sector have been two of the top performing sectors. In the past, technology has been a laggard in that environment. And even if you look at the 1995 scenario where you had a soft landing, there was a little bit of uneasiness with regards to the equity market before it started its surge forward. The defensive sectors once again took some leadership in that environment, but ultimately you started to see performance once again broaden out even after the defensive sectors started to lead there. I'd say the biggest challenge that I have with getting too cautious at the beginning of the rate cutting cycle is the way that the market's constructed today. Obviously, the Magnificent Seven compose a significant portion, about call it a little less, more than 25% or a little more than a quarter of the index. And so the growth that's expected from those companies over the next, call it 4 to 5 quarters, is far exceeds that of the rest of the market. So if we are heading into this slower growth environment and we do see a bid towards growth, the Magnificent Seven, those largest, most liquid companies, are ultimately gonna catch a bid in that environment.
Yeah, and for the people who follow the headline indexes like the S&P 500, there's obviously a historic concentration at the top of the market in those names, and so you cover up a lot of underlying weakness if those names are performing well and if they're growing earnings as you're describing. But let's zoom out a little bit on earnings. You've been kind of tracking the third quarter earnings and 2025 earnings estimates. The third quarter, the story is that earnings estimates are coming down pretty significantly. I wonder if you could talk about that a little bit and then maybe just give some context or a bit of an outlook for what we should expect in 2025.
Yeah, certainly. So obviously, just kind of take a step back. 2Q earnings came in quite strong, up more than 13%. We've seen some revisions to the third quarter numbers, which will ultimately be reported during the fourth quarter. So they initially, on July 1st, they were initially expected to be about 7.5%. That's come all the way down to about 4.2%. A lot of that actually is related to the energy sector, which makes a lot of sense given that we've seen a pretty significant decline in oil prices thus far. I think more broadly speaking, the questions are really out whether or not the 2025 number is achievable. And so the earnings estimates of about $280 a share is a little, it seems as though it's a little elevated right now, given that to achieve that number, you need the greatest margins on record. So that would equate to about a 13.9% margin profile for 2025 if we were to ultimately to achieve that $280 a share. That would be the highest margin on record going back the last 35 years. 2021, we saw a significant rise in margins, and that was about 12.4%. And that was largely on the back of the fact that costs were cut significantly due to just the economy being closed and companies literally not being able to spend money on many of the items that they would have otherwise been spending on. I think I think the most challenging component right now to that 2025 number is the fact that it operates under the expectation that we're going to see 5 to 6% sales growth. And that also, obviously, in an economy that is slowing, is one that is difficult to achieve. So I think right now the jury's out on whether or not we can get to that $280 next year. I don't want to say it's impossible, because nothing's impossible when we're looking at the financial markets, but it does seem as though it's a little more challenging. And then ultimately, what does that ultimately mean for returns going forward? I think we have to recognize that in the coming months, we've obviously seen higher volatility, and ultimately that usually is associated with lower returns than what we've been accustomed to over the last several years.
Yeah, that's a great point. And then the fact that valuations are already somewhat extended, you would start to expect a lot more of the return in the stock market to come from earnings growth. And as you mentioned, kind of a high hurdle for really, really strong 2025 earnings growth. But obviously expectations strong right now, so we'll keep an eye on it, and we'll certainly talk to you again before we get there. So Ryan, thank you so much for the time. Talk again soon.
Thanks, Ross.